From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for the first day of August 2025. Let's check the calendar. Well, the Brewers are out of town this week, but return next weekend for a series with the New York Mets. It's also a big week in West Allis, as the Wisconsin State Fair is underway with its usual assortment of outrageous food items. But they may have outdone themselves this year. How about a hunk of big fat Elvis ice cream sandwich? It's a Greavy's Bismarck donut stuffed with a heaping scoop of fat Elvis ice cream. That's banana ice cream with a salty peanut butter ripple and chocolate chips. Then it's drizzled with peanut butter sauce, and get this, crispy bacon on your ice cream. And finally topped off with powdered sugar. Seems like a sensible meal to me. Let's start with a news headline you don't want to wake up to. A radioactive wasp's nest was discovered at a former nuclear plant in South Carolina. The Department of Energy confirmed that the nest was treated and disposed of, and no wasps were found inside the nest. Probably because they were all dead. But their glow-at-night bodies were easy to find. You know, this is going to be a TV movie of the week. And the next one also has a TV movie written all over it. Robot bunnies, that's right, robot bunnies, are being deployed in South Florida. Of course, it's Florida. The bunnies were engineered to help cut down on the numbers of invasive Burmese pythons. The state has released 40 robot bunnies with little heaters inside them to fool the cold-blooded snakes. If that fails, they'll resort to spraying little robots with little bottles of perfume. Even snakes can't resist the perfumed bunny rabbit. Sweet-smelling bunnies will be available for this Christmas season. On the broadcast today, we have Art Rothschild, Tom Pappenfus, and with a wrap-up of the week, here's Joel Dresang.
Thank you, Max. It was an interesting week that ended August 1st. We had lots of losses on the major exchanges. The NASDAQ, the tech-heavy index, dropped 458 points this week. That's 2.2% to close today at 20,650. The S&P 500, which is a broader index, fell by 151 points, or 2.4%, to close at 6238. The Dow Jones Industrial Average lost 2.9%, or 1,313 points this week, to close at 43,589. And the U.S. Treasury, the yield on that went down 17 basis points this week to close at 4.22%. It started the week at 4.39%. It started the year at 4.57%. And also going back to the beginning of the year, the NASDAQ so far this year is up 7.5%, and that's including dividends. The S&P 500 is also up 7.5%, and the Dow Jones Industrial Average is up 4.2%. Art, there was no loss of things to talk about this week. We started out kind of warm. The S&P 500 was on a winning streak. It had a record high on Tuesday. That was the sixth record high it had in a row. And we over the last weekend, there was a U.S. trade agreement with the European Union that seemed to settle a lot of questions about some of the tariffs that were going to be happening with one of the U.S.'s biggest trading partners. And then other things happened. We were expecting the big news this week to be the Fed meeting on Tuesday and Wednesday, in which they were going to be setting short-term interest rates, and we expected that to basically say we're not changing them at all. And that's what happened, but there was more to it than that.
Yeah, I think that was a foregone conclusion. But once again, it was tariffs, I think, that dominated the conversation. As you just mentioned, we had some deals. The European deal was a big deal. That's how we came into the week, set records Monday, maybe into Tuesday. But just like the Brewers had to lose one or two games, recently they had a nice streak going too. I think investors shouldn't obsess over what happens day to day. I think they should understand why things are happening when they happen. There's no real news here this week. It's just a continuation of the same concerns. What impact are tariffs going to have on the domestic and global economies? And we learned in April how devastating it can be when you make threats of huge tariffs and when investors and economists conclude how that might negatively impact the domestic and global economy. So we had a roller coaster ride, fortunately contained within that month. It's been a relief to be making money, time and time and time again since April. And we did have we made money in June, we made money in July.
Right. The S&P 500 is up 25%.
Yeah, from the bottom. It's a great
April
statistic
8th,
you
yes.
put there. But even for the year, the numbers are good, even up single digits for the S&P, up 7.5%, even after giving a little bit back today. So, the week, it wasn't really the news of the week. It was just a continuation of the same old story. But losing money isn't fun, so people should just suck it up and stay in the game, be well diversified, not overdo anything, because you never know what's going to happen day to day.
Yeah, and we had economic news this week, the big report on the gross domestic product, which is the biggest measure we have of the economy. That showed a 3% pretty healthy economic growth rate for the second quarter. We had jobs numbers that came out today, which that report was apparently worse than I thought, because after it came out, the president threatened to fire the commissioner who was in charge of those numbers. But that actually was showing a weaker employment market, but still not altogether bad. And then we also had numbers on inflation, on the Fed's favorite inflation number, and those were looking like inflation was going up a little, but they're not too far from the Fed's long-range target of 2%. Tom, you and I were talking before, and you said that, it looks like the economy is getting a little weaker from some of these numbers, but it's still pretty solid.
Yeah, I think kind of the theme of this week is, to Art's point, we're going to stay put on interest rates. Markets largely expected that. But again, kind of a continuation of a number of statistics, with jobs and payrolls. Even looking at purchasing manufacturers index is still in contractionary territory. Just a general sign that things are weakening a bit. And, as noted in weeks past, a little bit of perhaps inflation on the uptick. So I think that's led to a week in which we've seen volatility spike. I think the VIX index has gone up about 20%. And you've seen, as you noted earlier to start the podcast, that the 10-year Treasury has dropped. And Art and I were kind of mentioning, just kind of a reaction to, perhaps investors are going to a little bit more defensive right now. But at the end of the day, we are seeing some of these weaker numbers. It's kind of this, delayed impact from the tariffs. I kind of tell my clients that we haven't seen much, if any, impact from tariffs yet. It's just starting to hit balance sheets. The invoices are coming in, starting to get paid, and we will only just start to see how that those higher prices are passed on or absorbed. And may be reflected ultimately in earnings, which is obviously what we care a lot about. So interest rates and earnings, again, the dominant theme that everything goes back to. But, you start to introduce some of those concerns, some of that slowing, and you see the markets kind of take a shift and take some profits, take some gains, because we are looking at elevated, price to earnings multiples right now at 22 times earnings, and against a fairly high recent 10-year average in the 18 to 19 times future earnings. So, I think we all tell our clients, stocks are expensive. If you have cash needs coming up, now is not a bad time. And now we're starting to see a little bit of this weakness, and nothing overly scary, because I think fundamentals are still pretty solid. We're seeing wage inflation still hovering around 4% growth. Right,
still beating inflation.
Yeah, absolutely. The unemployment number still ticked up, but it's at 4.2, which is historically quite low. And so there's, again, a little bit of cracks starting to show up, a little bit of weakening, but no need to hit the panic button yet. It's just kind of, part of this slowing we were kind of waiting for.
And one of the surprises of the jobs report today was that there was a really big correction for the previous 2 months, and the numbers that came on a number of the jobs that were created. According to today's numbers, the last in May and June, the U.S. added 33,000 jobs. Before that, it was estimated that was 291,000 jobs. So that's quite a correction, which makes, of course, the job market look a lot weaker than we thought it was, and which is a surprise today. And the numbers that came in for July jobs was 73,000, and you combine that with those 33,000 from the 2 months before. That's less than what analysts were expecting to have been created in July. So that happened, but it's also, to me, a reminder that when we look at these monthly numbers, a lot of times they're corrected later on. A lot of times they're revised because of statistical errors, or they're getting more information in. The GDP report this week was the first of 3 reports, and a lot of those vary greatly between reports just because they're getting more information to inform what they're arriving at. And those are the numbers that the Fed keeps talking about, that they're looking at, all those numbers in deciding when to start lowering interest rates again. And do you have any more thoughts, Art, on that whole situation?
Yeah, the unfortunate truth about the numbers is they're all distorted. This is unprecedented times. This is an experiment we're going through. Tariffs are something that hasn't been done like this since the 30s, and we're talking 1930s. So it's a concern. You talk about GDP. GDP went down because we took in a bunch of imports one month, and it goes up because we didn't take in as many imports the next month. Right. So these numbers are distorted. The president has started, he really is the source of the uncertainty. He's claiming to be remaking the landscape in this country economically by virtue of these tariffs. We're going to get $150 billion more of revenue from these tariffs, or we just did already. That money came from somewhere. And as was evident this year from profit reports from Ford, General Motors, Stellantis, all these other companies, forecasts from Procter & Gamble suggesting they're eating a bunch of it now, but they're not going to be eating it in the future. They're going to be passing these higher, these tariffs on to consumers in the form of higher prices. They can't exist if they keep losing money. So,
or they're going to be reducing their profits, so their shareholders
they just did. They just did, and so they're not going to do that forever. Right. So this could all go away if the president was all of a sudden to wake up and say, well, we tried it and it failed, but he's not going to do that. We're going to keep pressing forward with tariffs, so the uncertainty is going to continue. And I think that's why stocks went down as much as they did today. I mean, he's pressing some countries that haven't come to the table yet and made an agreement, and then he's trying to force Brazil or Canada or some other, Switzerland maybe, to do things that they don't want to do. And plus, there's a fight in the courts right now. There's a court case that was heard in federal court today about the validity of all of this. But we have to, we're in the environment we're in. We have to expect volatility, as Tom just mentioned, because of the uncertainty that's evident, because we do not know what the impact of tariffs is going to be, and which is why the Fed had to, they're on the fence. They don't know whether the biggest problem is prices are going to go higher or employment's going to go lower. So they're sitting there waiting for 2 more months of data. In September, they think they'll have a clearer picture. I'm not so sure. But I still think they're going to lower rates because I think the threat to a slower economy from the tariffs is bigger than the concern about higher prices, which have to come through.
Sure. So there's the political or the policy uncertainty, but there's also the uncertainty of the impact of these tariffs, these taxes, because as you said, we haven't been here before, so we don't know exactly how companies are going to be able to absorb any of that, or how they'll be passing along that extra cost.
Well, I think we go back in time, back into April, kind of at the worst of all this, and at that moment, we didn't really know the extent of the tariffs. What percent? Are we at 10 or are we at 50? And it was, huge numbers were being thrown around left and right, and obviously paralyzed, investors, and markets dropped quite a bit. Time has been the friend, because we've seen a change in that there was a backtrack from the most extreme of the numbers to more normalized, and I think companies have been able to now start to digest what seems like a more realistic number. And when they get to that point where they can start to have numbers and have analysts plug those numbers into models, we start to I think they've grown more comfortable with being able to project and to being able to forecast. And obviously that puts investors more at ease. So it's created a little bit more, and that's hence, from let's say May to up until this point, volatility has dropped. It's been a fairly, as much as we saw a huge spike in volatility initially, it's been more subdued and back to historically pretty low levels. And that's just a result of I think companies, and you're starting to see the earnings growth revisions upward again. We started out coming into this year with a clean slate that earnings growth looked great. Obviously as a result of the tariff fears, plunged, perhaps cut in half for earnings growth estimates for the year. Now we're back at, I think the FactSet numbers, Joel, that you had, where we're looking at perhaps as much as 10 to 11% earnings growth of S&P companies and 14% next year. So
that doesn't sound bad.
That doesn't sound bad, and it's yeah, absolutely. And so it tells you that, well, I think we've gotten to at least a place in a very uncertain world where I think the range of outcomes has been at least narrowed to some effect. It's not stable or easy, and there's still all these, unintended outcomes that may come from this that we don't yet know and may come down, later. But at the very least, from how analysts model out, and they're looking 6 to 12 months ahead, not terribly far like our long-term investors, but for what they can see, they're looking at earnings growth numbers, and things are pretty much on track.
It seems like we've got a TikTok attention span, but what we're dealing with is more like Pony Express, right? I mean, it takes a while for the message to get to us to figure out what's going on. Is there a way that investors can discern or deal with this short-term volatility and what they're working for the long term?
I think blinders. You have to keep going in one direction, and that's what we counsel our clients to do. We develop diversified portfolios, balanced portfolios, so when the stocks are going up and down like crazy, which is what you should continue to expect, even though we've had some stability since the April shocks, I think we should expect volatility.
So they can still pay attention to the news and see what's going on, but they're not worried about it as much.
They should definitely be well informed, but they shouldn't overdo their allocations to equities such that they lose sleep when the market goes down. Again, this has been an excellent year so far, still is, despite, giving back a little this week. As Tom indicated, April, it was self-contained. We lost a whole bunch of money, got it all back. As you've noted, we've come back tremendously from the lows.
And remember, in April, it felt like the end of the world.
They were, given, as Tom mentioned, the magnitude of tariffs that were being proposed, economists were suggesting we were going to have a recession. That was big. They've retracted those, projections because, as Tom indicated, they've reduced their expectation for the overall rate of tariffs. So what all of our clients should be doing is, if they're getting so much a month, focus on what you're getting per month. Focus on the fact that we've made sure you have enough in fixed income to cover those distributions. That's what we do here. As far as stocks go, expect to make money over long periods of time. We see it every day. I've got clients who've been with us as a firm or with me personally 10, 15, 20, 30 years and have made maybe some average percentage per year. They've been incredibly successful, and they've been able to live comfortably, spend comfortably, and they can always talk to us if they're concerned. And quite frankly, that's the advice I'm going to give to anyone listening. If they're concerned about this week's volatility or volatility in general, call your advisor. Ask them what's going on. Ask them for a reasonable expectation of what to expect. We don't know what to expect, at any point in time. But over the long periods of time, we know stocks are going to make money, bonds are going to have less volatility and provide, a smooth ride in connection with a well-balanced portfolio.
That's one thing I learned early on working here, is that what you guys do is manage expectations.
That's
and
all.
A big
They were
part
counselors,
of your job.
coaches and counselors, and pretty darn good asset allocators.
Tom, what about younger investors who are still working for a living and they're not relying on their investments so much for the money that they
Don't
need
worry
to...
about it. I mean, put it in, don't look at it. I tell people that's the best thing you can do for your health is just let it grow. Plant the seed, let it grow, check in on it, stay in growth stocks, stay in, S&P 500 companies. You'll be fine long term. It's just not worth the headache and trying to play the game. And studies that have been done with, comparing when you invest money to, how you parse it off over future installments. Just the one time, as Bob would always say, just the time in the market is your best friend. And so even when you further studies that have taking a deeper dive to study, investing when the market is expensive versus waiting for when it's cheaper, has shown that is only slightly marginally beneficial to the outcome, and not nearly enough to try to take the time to invest the time to try to figure out when the market looks expensive and when it looks cheaper, to try to pick that, to just put it in and let it work. Kind of back to your point about, I think a lot of our meetings have to always, it's a combination of a conversation that marries short term and long term. What's happening. I think every meeting I have with clients, I always try to understand what short term needs do you possibly have. That's where a little bit of strategy can come into play as to whether or not I think it's a good time to take money now, even though you don't have a need for the next several months, versus waiting and to doing. And so, as I kind of started off earlier, saying that for a lot of clients, I think the market's expensive. We have some volatility. If you have some cash needs, let's just take it out now. You can preserve that value. But I think the long end part of this comes with how we assess and analyze our investments that we choose, because I always try to remind people that, especially with actively managed mutual funds, is that these investors and their team of analysts generally have a 3 to 5 year outlook. So it's I always have to try to understand, when I look at year-to-date performance, when we come into any review, whether it's 3 months or we're meeting now and it's 6 months out from the beginning of the year, that, well, this one's underperforming a little bit. Do we cut ties with it? Do we move on? And part of me, I have to look at the long term and understand, well, why is it underperforming? And, is that something, is this part of a trend? Is this part of a bad management team picking stocks? Or is this just part of, hey, this is just not the right environment at the moment for the companies they do own, and we should stick with it because you trust what they're doing. And ultimately, it's a constant. I think that's probably our toughest part of our job, is just trying to understand, well, how long do we continue to own these companies or funds, and when do we cut ties with them to either raise cash or for, cut ties with them just because they're not doing quite as good of a job for maybe the environment. And so we always have to try to understand those lengths of time.
Well, there's the old saying too: we have nothing to fear but fear itself. And there are a couple of fears that, I talked about in my show notes. There's fear of missing out. So as the stock market's going up, everybody's, paying more and more. Price earnings multiples are getting higher and higher. This week we had a gut check. Things went down. So now it's fear of losing money. So you have to really control your emotions as an investor. Again, that's where we come in, just providing a little guidance along the way as to, hey, what are you worried about? So, and that's where fear is. Another of my favorites I mentioned in my notes was, Bob's comment on volatility. It's like you put your hand in a bucket of water and you splash it around. Right. You take your hand out and things will settle down. And it's just my favorite picture of what's going on when the markets are volatile. It's stuff splashing around. And so over time, if you look at it, the water's going to be there. It'll settle down. You're going to do fine.
If you just leave your hand in the bucket, it'll settle down too, right?
Well, true, but
yeah.
You could get cold or hot depending on what kind of water you're dealing with.
All right. Well, thanks for listening, everyone. With that, I'm going to try to find me one of those Hunka Elvis ice cream soups. And we'll talk to you next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.